If you're hunting for the next big AI play that's been beaten down but is poised for a massive comeback, stick around. Today we're diving into UiPath, the automation powerhouse that's just dropped killer Q4 earnings, yet the stock's tanked nearly 30% this year alone. Is this a trap or the buy of the decade? By the end of this video, you'll see why I'm calling it an absolute steal right now. If you're new here, smash that like button, subscribe, and hit the bell. Let's get into it. First off, for those who don't know, UiPath is a global leader in robotic process automation, RPA for short. They use AI to automate boring, repetitive tasks in business, saving companies time and money. Think of it as AI agents that handle everything from data entry to complex workflows in healthcare, finance, and more. With the AI boom, UiPath's agentic automation is exploding. They're not just bots, they're smart systems that learn and adapt. Founded in 2005, they went public in 2021, and despite market volatility, their fundamentals are rock solid. Alright, let's talk about numbers. UiPath dropped their Q4 fiscal 2026 earnings yesterday after hours, and guys, they crushed it. Here's some of the highlights. Revenue hit $481 million. That's a 14% jump year over year, beating Wall Street estimates by over $16 million. Analysts expected around $465 million, but UiPath delivered big time. Annual recurring revenue, ARR, clocked in at $1.853 billion, up 11% from last year. That's the steady cash flow from subscriptions. Super important for SaaS companies like this. Net new ARR, $70 million, showing they're still adding customers and expanding deals. Non-GAAP EPS came in at 30 cents, smashing the consensus of 25 cents by 20%. Some estimates were as low as 20 cents, so this was a massive beat. And the guidance? Even better. For Q1 fiscal year 2027, they're projecting $395 to $400 million in revenue, above the $393 million estimate. Full year fiscal 2027, $1.754 billion to $1.759 billion, topping the $1.74 billion consensus. This isn't just growth, it's acceleration in a tough market. UiPath's AI integrations are paying off. They're seeing strong uptake in agentic AI for sectors like healthcare, and their recent WorkFusion acquisition is boosting their enterprise play. No wonder they've beaten earnings estimates in 17 straight quarters. But here's the crazy part. Despite these stellar results, UiPath's stock has absolutely plummeted. Year to date in 2026, Path is down a whopping 31%. Trading right now a little above $11, $11.33 as you can see. From its 52-week high of about 1984, that's a 40% drop. You might be asking yourselves, why the drop? Broader market jitters on software stocks, inflation fears, and some pre-earnings sell-off shares dipped 3.2% right before the report. Post-earnings, mixed reactions. Some after hours selling shaved off another 3 to 4% even though it initially popped. But look deeper. Short interest is sky high at 23% of the float, setting up for a potential squeeze if sentiment flips. The market's overreacting. Path's trading at a forward PE of just 15.4, way below the industry average of 28. Analyst average price target, $15.93, implying 30% plus upside from here. Some narratives even peg fair value at $21.54. That's nearly double. So why load up on Path today? Simple. Undervalued growth in a red-hot AI sector. Automation isn't going anywhere. With labor shortages and AI hype, Path's positioned to dominate. Their 11% ARR growth in a slowed-down economy, that's resilience. Plus, new AI certifications and healthcare expansions mean more enterprise wins ahead. At current prices, you're buying a company with double-digit revenue growth at a bargain basement valuation. If the market wakes up to this, especially with a short squeeze, we could see a quick 50% rebound. Don't sleep on it. There you have it. Pat's Q4 earnings prove the business is firing on all cylinders. But the stock drop is your entry point. What do you think? Buying the dip or waiting? Drop your thoughts in the comments, like if this helped, and subscribe for more breakdowns. Thanks for watching, and I'll see you in the next one.